In 2023, we expect to see a continuation of what we saw in this morning's CPI report, a sequential slowdown really led by goods more than by services. Some of the themes that you saw in this morning's report, I think, can run for a long time. For example, we saw weakness in the used car category and in the new car category coming in flat as opposed to being up pretty aggressively over the prior year. The story here is something we've waited a long time for. Essentially, as supply chains get fixed, production picks back up, inventories get rebuilt. We're moving from an environment of scarcity that pushed up goods prices back to a more normal environment where goods are more abundant and competition is pushing prices back down or at least limiting price increases. I think that can last for a long time. It doesn't necessarily mean that you've solved the service sector inflation problem. The Fed still needs to rebalance the labor market, still needs to get wage growth and labor-intensive services inflation back down to target compatible levels. That's going to take quite a while. I think we'll make some progress in 2023, but that's probably a story that will extend into 2024 as well.
And it certainly sounds like that sticky services inflation is going to continue offsetting the drop that we're seeing in goods price inflation. So you're talking 2024. So anyone who's been hoping for a pivot to the dovish side in the Fed, in other words, hoping for maybe an about turn or even a cut by the end of the next year, it sounds as if they might be disappointed.
I'm not expecting cuts next year. I do think Fed officials feel strongly about slowing the pace of tightening. We'll see a slowdown to 50 basis points tomorrow at the December meeting. And then we're likely to see, I think, a further slowdown to 25 basis points, most likely at the February meeting. From my perspective, the Fed's policy tightening this year is working pretty well in slowing demand growth to a pace below potential supply growth, rebalancing supply and demand, especially in the labor market. And it's not going to happen overnight, but eventually that will help to dampen wage growth and inflation. And I think Fed officials also feel that that's gone well. And so they're very reluctant to move at a pace that is so quick that they don't give themselves time to gauge the impact on the economy, and they risk overdoing it. When you're headed in the right direction, I think it would be a mistake to tighten too quickly and wind up doing more than you think. And I think they feel the same way and are very inclined to slow the pace. It could mean that we need more hikes, could mean that we need fewer hikes. The key is just to move at a pace where you don't risk overdoing it. In 2023, I think the overriding goal is to keep demand growth below the economy's long-term potential growth rate, but also positive out of recessionary territory. Fed hikes are one thing that will influence the pace of demand growth, but there are many things, and they'll need to react to that. If financial conditions ease too much and growth threatens to reaccelerate, they might need to do a little bit more. If business confidence deteriorates by more than we're expecting, possible they would need to do a little bit less. The key is to keep growth, below potential but above recession, so that we continue to see the rebalancing in the labor market that we've seen this year.